Hi, welcome back to class. So
Hi, thank you.
today we want to see how we can model the costs in our financial model. Let's go back to our assumptions. So one thing is once you have your case study, you just replicate everything in your case study in your assumptions tab, right? We've been able to replicate what we have in our case study, especially the one that is under the cost assumptions. Let me make this thing bigger. Yeah. So for our costs, we have two types of costs, right? Variable cost and fixed cost. So let's just go to our note and do something. Mm. So we have the types of costs. So the types of costs we have includes the variable costs and we have the fixed cost. Is that correct? So can someone tell me about the variable costs? Tell me the meaning of variable cost and give me an example of variable costs.
Okay, so there are costs that they are not fixed or constant. They can change.
They can
I've
change.
forgotten the specific definition, but it's not constant, it's not fixed, it can change.
Mm. So they actually increase in direct proportion
So
to
because
sales
that's
volume.
our merchandise material, direct labor,
Okay,
and
those are
overhead.
the examples of variable costs, right? Raw
Yes,
materials, raw material costs, right? Direct labor.
labor and overhead.
Labor, okay, okay. Yeah, we can employ more laborers if we want to increase our volume of sales or production, right? Direct labor, basically. Can you give me more examples? Okay, you can think of more examples and put them in your notes. Right. What else can we talk about variable costs? So one thing about variable costs is that they are always forecasted in they are always forecasted on per unit basis. Right? When you want to forecast variable costs. So you don't just forecast variable costs in aggregates because they change and they actually change or they increase or decrease in direct proportion to your volume, right? So for example, you need to know the unit of raw materials you are using to produce, right? You need to know the number of direct labor you need to sell a particular quantity of products or to produce a particular quantity of products. So you need to forecast them per unit. You can say um if you need 5 units of a particular raw materials to produce this, right? So if you want to produce a higher quantity, you need a higher number of raw materials, right? So that's why we need to forecast this variable cost on per unit basis. And you also grow them into the future on per unit basis, right? So you don't aggregate them when you want to grow them. You need to forecast them on per unit basis and also grow them on per unit basis. So let's talk about fixed costs. Let's talk about fixed costs. What can we say about fixed costs? So Faith, it's your turn. Tell me about fixed costs.
There are, sorry, there are costs that are not flexible. They are more of costs that are fixed,
Mm.
and they don't increase. Wait, so
They don't increase. They don't
they don't increase
increase.
in
uh,
proportion to
mm,
sales. They are fixed,
yeah, they don't
basically.
increase in proportion to sales, right? So fixed costs basically they remain the same, right? So they don't increase. Let me use your let me use your words. Fixed costs.
Can you hear me?
Yeah, I can hear you. I'm borrowing your words. Fixed costs
Okay.
don't increase in proportion to sales, right?
Hello?
Yeah,
Ah,
that was what you said, and that's correct. So examples of fixed costs includes, can you give us examples of fixed costs? Anybody?
Like rent,
Rent, that's correct. Which other ones? What other costs are fixed?
electricity tariff.
All right, electricity, especially for the administrative block, right?
Electricity tariff. Can you hear
Mm,
me? Okay.
we can take
My
that.
voice is
So electricity tariff, etc. Can get more examples. So how do we forecast fixed costs? How do we forecast fixed costs? Can you guess how we forecast fixed costs?
mm,
We forecast fixed cost in aggregates, in aggregate value, right? That is in total naira value. Can't see this, can't see this. Need to move this away. Mhm. All right, so we forecast fixed cost in total naira value or in total value or in aggregate value, and we also grow them into the future in aggregate. All right, don't worry, we'll demonstrate that from our case study. All right. So that's basically one thing about fixed costs, right? So, and there is one thing you need to know about variable cost and fixed costs. So there is a term called operational leverage or operating leverage. Operating leverage. Let's talk about operating leverage. Do you want to guess what it means?
I would say it's probably the advantage that a company has,
Mm-hmm.
like more of a competitive advantage they have over in the industry they are operating in.
Okay. So what's this advantage all about?
Well, it could be maybe maybe they have direct access to some vendors or raw materials that other companies do not have.
Mm,
Other companies that operate within the same space. So because of it, they might have more reduced price. So they have price competitive. They might have price as their competitive advantage, like lower
mm.
price.
Yeah, you've just used competitive advantage. That's the meaning of that. Sorry, you can mute one device. So
So what did you
basically,
say?
I say you can mute one device from your end.
Yeah, you said that you were trying to make a comment on what I said.
Yeah, what you just described is competitive advantage.
Okay.
Yes, competitive advantage. I think you also mentioned it, right?
Yeah.
Only do you want to give it a try? Competitive advantage, lower um, lower prices, or they have access to raw materials, right? In this case, if a company doubles its revenue, if a company doubles its revenue, let's say a company makes more revenue. For example, if a company makes let's say 2,000 this year, and in the following year they make 4,000, right? They make 4,000, sorry. They make 4,000. Let's say they have a cost in this year, they have a cost of 1,000. Um, Let me say, let's just say their variable cost is let's say their variable cost is 200, and their fixed cost is 800. Let me reflect this as minus. So let's see if they double their revenue. You can see in this case they've doubled their revenue here. This is their revenue, and this is their variable costs, fixed costs, right? Let's say what are we going to put as their, let's say you know that basically variable cost increases with volume, right? Let's say if they have made more sales, of course they must have increased their variable costs, let's say to like 400. Fixed costs might not actually increase that much because we said by definition that fixed cost does not increase in proportion to revenue, right? So let's say fixed cost might just be like 850 here, right? Or it might just remain the same. Let's just keep it same, right? For example, rent for some people pay, some people's rents remain the same over 5 years, especially in this part of the country. So if you are paying rent of, let's say you are paying rent of 2M this year, next year your rent might still remain 2M. So let's see what will be the addition of all these, or the sum of this. You can see profit. Let's make this as the profits, right? And if we do the same thing here, you can see that profits, you can see that revenue doubled here, right? But profits more than doubled. So operating leverage is one is one concept that says that if a company doubles its revenue, what will happen by doubling its volume? Then its profit should more than double. Now let's look at this. We said that if a company doubles its revenue by doubling its volume, then its profits should more than double. So we are going to make sure that all these things are inputs. Of course, I'm still going to remove them. These are inputs, right? So we can see that we have doubled. These are variable costs. These are just hypothetical figures. We've doubled this variable cost because basically variable costs move in proportion with volumes. So if variable cost the first year was 200, variable costs, because we doubled volume, we expect that variable cost should be 400. Now you can see we doubled our volume here. At the end of first year, profit was 1,000. At the end of second year, profit was not just 2,000, it's above 2,000. So that's the operating leverage. If a company doubles its revenue by doubling its volume, then its profit should more than double. Okay, now explain it in your own words. Hi, Faith.
So, in my own words, I'll say that if a company doubles their revenue by increasing their volume of sales, then that means that their profit will be doubled because the fixed cost is not affected. It's just the variable that is affected. So because of that, there is no deduction or minus coming from the fixed cost aspect. So because of that, the profit should be more than double.
Should be more than, focus on more than, right? More than double. You can see, assuming this profit was just doubled, it will be 2,000, right? But you can see it's more than 2,000, right? So the profits they are going to make will be more than double. Because we have replicated our case study on our assumptions tab. So we are going to use this to build our calculations tab. So see what we're going to do. We just come here. This was our revenue calculation. Oh, see our spelling of revenue. And somebody did not tell me. Okay, so what I'm going to do is just to copy this, come here and paste. So I'm going to change it to what? Cost of what? Operating costs. Let's see, what's here? Operating cost calculation, operating cost assumption. Just come in here and paste it. So I will just change this assumption to calculation. So now let's think about this. If we want to calculate our operating cost, we have two types of cost. So what we'll do is first to go and collect all our assumptions under the operating cost assumptions, just bring them to so when we copy this, right? Of course, we have something under our units. We can paste it as well. Right, so the variable cost is cost per unit. The values we have under the variable cost are cost per units. Right, so let's see. Under this, we have this. I remember these are linked. So let's use Alt 4. Let's use linked cell style. Is that it? Yes, that is it. Now, we can go ahead and bring in all the values that we want to use for our cost calculation. But then remember that since this is a variable cost per unit, so what we are going to do is, let me just show you something. Let's see the steps we need in calculating our cost schedule. Right, let's talk about it here so you keep it at the back of your mind. Let's see steps in calculating so you don't need to guess. Control B, Control U. So we have some steps you need to follow when you are calculating the cost schedule. First thing, we have variable cost. And for example, in this case study, we've been given variable cost per unit, and we have been given fixed cost, total or aggregate amount. These amounts are in millions. So what we're going to do is, let's deal with the variable cost first of all. We are going to calculate the variable cost. Our variable costs, we are going to build our variable cost on per unit basis. Are calculated. So you are going to calculate your variable cost on per unit basis.
If I when you were saying this, I was like, thank God for income. It was only God that was not even clarifying that. You remember that they were opposite. I was not even telling him that. You cannot now call my attention to it. So that if you had told me immediately that she greeted you, I would have, but you did not tell me. She said it too. That I just noticed it like briefly. Like it's not that I paid attention
Imagine
to
person with a
it.
class.
No, no, please, I will not do that. No, please let me go there. Let me apologize. No,
It doesn't know it's not muted.
You don't know.
yes, ma'am.
Mhm.
For me, next time, please call my attention to it immediately.
So step one, oh yeah, I can hear your voice.
Oh,
Imagine,
sorry.
imagine that I record I make sure I do not cut out
Since
this part. All your discussion
when
with your man, I won't cut it out.
man,
I'll upload it on YouTube.
that's not possible.
So you have been discussing with your man and you are,
That's not possible.
I must upload it. Mm? So step one is you need to calculate your variable cost on per unit basis, right? So what we are going to do is we are going to calculate our variable cost on per unit basis, right? So this is our variable cost, right? We have a forecast here for 2017. So what we are going to do is to calculate it on per unit basis. Make sure that variable costs are built on per unit basis. So this is a per unit variable cost. How do we grow it over the years? How do we grow it over the years? How do we grow it over the years? That means we need our inflation, right? Because
Yes.
costs grow over the years. So, but then, so what we'll do is look for our inflation. Our inflation is in our assumptions. Go there and get it. You see under this operating cost assumptions, we have growth in operating cost inflation. All right, so let's pick this value here. We need it. If you copy it, you copy the unit value, that's percentage, and you'll see other values in other years. Remember, if you paste it here, Control V, then you put it in linked cell style, right? You remember it's in percentage, also put it in percentage. So you can see the first year is not growing. Nothing is there, right? Because we already have values for the first year, right? So what else do we need when we are calculating this, our operating cost? We need the volume of sales to calculate the total values, right? So where do we get that? Let's go up. We've calculated one sales volume up here. We can see its volume under the revenue calculation, right? So when you link it, you repeat, you link and repeat. So I'm going to also paste it here, Control V. Can you see how I'm easily linking it? Once you just link it, then you copy this one, it will just reflect, you know, it will just reflect. I mean, do you understand what I'm trying to say? You also show that you have linked it by using the linked cell style that we've designed here before. So we can go on and calculate. Let's remove SS rows. Do you know how I did that? So this is our step one. Our step one says, can you remember the step one? It says that variable costs are calculated on per unit basis. Since we want to calculate it on per unit basis, this is our cost per unit, variable cost per unit. And this is the cost for 2017 forecasted year. The following years, we're told that variable costs, they grow by inflation. So we just grow it. Remember how we grow this, right? Times open bracket 1 plus inflation, right? So since I don't want it to leave that row, I'll press F for how many times? 2 times. I close it.
Yes. Control R.
Yeah, I can either press Control R or I hold it, select it downwards, press Control D, then select it rightward, press Control R. You remember, right?
Mm.
Okay, all right. So we are just going to do a total for this, right? Let's just do this and press Alt equals to. No, that's not what I want to do. I want to press Alt equals to for this to make sure it's an addition, right? Control R. So I'm just going to show that it's voltage, show that it's a summation, right? So that's for that. So what we are going to do next, or let's do this. We're just going to bold in this, right? Total variable cost. So the next thing to do is to derive our variable cost in aggregate. Now, this variable cost we've done here, we can derive it in aggregate too. I can just copy everything from here. Let me just copy everything from here. Control C. Let's see if there is a better effective method, you can use that method. Nothing is here. Okay, it's not working. It's not what I want. I just want to repeat what we have here. Right. Control C, Control V, Control V. Right. Okay. Control V. So, but this is not what I want here. The unit is I want to calculate the aggregate of the variable cost, right? That means I want it to be in dollar amounts. Remember, our unit of measurement is dollar. That's $1,000,000. Control D. Right. So that means we need our quantity here. Remember what we used to grow the per unit cost was percentage, right? The cost inflation. In this time around, we want to calculate the aggregate amount or the cost in million, right? So I can just say this is the cost in million, right? While this one is, I can just add a row here. This is the cost per unit. So for us to get this cost in million, right? What we'll do is just get this, the unit cost multiplied by, what did I just do? The unit cost multiplied, escape, equals to this unit cost here, right? That's for the raw materials, the unit cost for the raw materials multiplied by what? Follow me. The sales volume. Is that correct? Did you get it up to this stage?
Yes.
Okay, how I got the cost. Remember, the variable cost per unit are these amounts.
Mm.
Now, what we are doing is to calculate it in dollar amounts, right? So
Mm.
we just did that by saying the unit cost times the sales volume. Now, since our sales volume is in 1,000, what we'll do is to divide this by 1,000. We already have a cell
Also,
named 1,000, right?
by thousand, yeah.
Yeah, by 1,000, yeah.
Mm.
Yeah, so we'll just control D. Oh, we didn't fix one of those. We didn't fix that row. Which row are we
So,
supposed to fix?
mm.
Which row are we supposed to fix? Can you tell me?
um, row L31.
Thank you. Thank you. So we are fixing 31, putting dollar sign in front of 31. It's like somebody already slept very well and is feeling healthy. I'm refreshing. Control R. Right. So what we are going to do is just to add up the total variable cost here. Control D. Oh, no, that's not correct. Alt equals to, does the alt equals to work? Let me see. It works for one cell here. Let me see when I link it, does it work? Okay, it's the same thing. Okay. So look at it, F2. F2 again. You can see it's adding up all this. Do you have any question before I continue?
No, I don't.
Okay, so the next step will be to calculate the fixed cost. Fixed cost must be forecasted in aggregate. When we say we want to forecast fixed cost in aggregate, okay, let me go back to this note. We said step 2 will be, let me edit this. Let me make it step 2. Step 2. What did we do in our step 2? We derived the variable cost, right? In aggregate.
Mm.
In aggregate. How did we do that? By multiplying it by our sales volume. Is that correct? So let's see step 3.
Mm.
Step 3 would be to get fixed cost. fixed cost. To forecast our fixed cost in aggregate. So let's go and do that. Let's see how we'll do that. Let me save this thing before it times out again. Give me a minute, please. You can see it. Please. Okay, so once we get our fixed cost, you can see we've not started working on our fixed cost yet. So we want to get our fixed cost in aggregate first. So our fixed cost in aggregate is the fixed cost in $1,000,000. So look at our assumptions here. See the fixed cost we are given here. It's actually in aggregate. So let's forecast it in aggregate. We are going to forecast fixed cost in aggregate. So we are going to repeat what we have there first of all. So what we're going to do is just like we have variable cost here, we have fixed cost. Remember, I'm not working under cost per unit. I'm working under this cost in millions, right? So because I'm forecasting, just like I forecasted variable cost in aggregate here by multiplying it by the, how did we get this? Okay, okay. So let's work on fixed cost. We are going to forecast fixed cost. All right, fixed cost. How do we get fixed cost? So an easier way to do it, since we already have it in our assumption, is just to go to assumption and collect what we have there. Copy it, come here and paste it. You can just Control D, right? All the things you have there will just replicate. It's an easier way to do that. You still copy and come here and paste everything you have here. Okay. You are still you've copied it and you have something here, right? You still paste it here and link it alt 4 and use link sales type because you actually linked those values. So because we want to forecast it in aggregate, right? We know this fixed cost will grow. They will grow. We want to forecast. Forecast means you are you are predicting the value in the future, So we are going to use the inflation rate to forecast it, right? 1 plus what's the inflation rate? Remember, we have it here. Press F4 two times to fix that row, and we are good to go. Control D up to this extent. Control D, Control R, right?
And Control R.
Yeah.
Yeah.
Then what do you do? Alt equals to add up. Alt equals to. It didn't work for me. What? Oh, it worked. You need to hold down the Alt and press equals at the same time. If you leave the Alt, it will be showing you shortcuts.
Okay.
Yeah. So you try it on your end or at your end. So what am I going to do? Let me select everything then. Alt HBP. Then I'm going to bolding it. Took my time. All right, let me replicate it here. Alt HBP. Then Control B. All right, so this is the aggregate, fixed cost, right? So the final step is to remember, we are not done with this cost. The final step is we want to get the fixed cost per unit, just like we have variable cost per unit here. Now it will be easy for us to do. Can somebody guess how we are going to get fixed cost per unit? Remember, we have fixed cost in aggregate amounts. This is the aggregate amount of your fixed cost. Mm, mm. What you can do here also is say total, total what? Operating costs. Total operating costs. we've actually gotten our variable cost and fixed cost. It's just an addition of this plus this. Is that correct? Your fixed cost plus variable cost. Control R.
Mm.
So I'm going to bold in this. And I'm going to use let me see. Alt HB. I'm going to use this up and down here. Let me use this top and tick bottom border. Right. This is the value we are taking to our financial statement. Why is our cost so low over here? Check out this year. What happened to this year? Let's see what really happens. Uh-huh. 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 Oh, something is not right here. Let me see. F2. No, 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 no. I was wondering what happened. Can you see? Can you see?
Mm.
Can you see that 9 there? We must have mistakenly pressed something. You can see. Control R.
Yeah.
I just saw that that cost there is just different from every other one. So that's how sometimes you need to look out for mistakes, right? Control R. So we know we have gotten our total operating cost here, right? But we need to get, it's important to get our fixed cost per unit, right? We need to get our fixed cost per unit. Let's say fixed cost. Now you're going to tell me why it's important to get our fixed cost per unit. So I'm going to just go to the assumptions and get this fixed cost again. And I'm going to, where did I put that? Uh-uh. No, 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 no. Get this fixed cost again, right? Control C, Control V. Let me see, Control V. Sorry, Control D, Control B. So I'm going to Control C and Control V to duplicate that. Gosh, escape. So we want to get fixed cost per unit. So this is our total fixed cost, right? So we want
Mm.
to get it per unit. So since it's per unit, I want to copy this Control C. I want this to be per unit. Remember, no, 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 no. It's dollar per unit. Control C. I'll just space value. Alt V. Just V again. Yeah, so we want to get it per unit. So how do we go about that? How do we go about that? Now look at this. Look at this fixed cost here.
Mm.
This fixed cost. Remember, this is in millions, right? So
Mm.
we are going to actually divide it by sales volume, right? Do you understand? Since
Mm.
this is our fixed cost for the rent, right? This is the dollar amount.
Mm.
So to know per unit cost of this, you are just going to divide it by the sales volume. Is that correct?
Yeah.
Okay, so we are just going to say this divided by the sales volume, right? So, but
Mm.
the sales volume is in 1,000 units. So let's multiply it by 1,000, right? By 1,000. Do you understand? Let me know if you
Mm.
understand. Oh, we didn't fix a cell. Which cell are we fixing? The sales volume. Control R. Alt equals to. Now this is our fixed cost per unit, and this is our total fixed cost per unit. Right. Let's do Alt B, Alt HBP, Alt HBP. Now, guys, this is the end of our costs calculation. The next thing to do is to link this to our actual model. So we are going to populate this model, the first thing to do is to replicate our historical figures here in our model. When we replicate that, then we can be linking each of those line items as we build them. So what we are going to do next is to link our computation, right? I want to link our computations to the main model or the main financial statement. All right, let me use Alt HB. Let's use this. Let's use this. So in real life situation, when you are working on when you are building your financial statement, what you do is you can make sure you design your model by replicating the financial statement, the historical financial statement. Right, let it so that you can link while you build. So you can link while you build. So what I'm going to do is, let's see. I don't want this to be on column C. Let's see. Can we put this on column D? Control plus. Let's see what happens. Does this go to column D? Yeah, I want it to be on column D. Does this go to column C or D? This one to be Control Z. Let me see. I want to do something. Control plus. I want this column C to be for navigation. Then column D for our normal text. Yeah. So what we're going to do is to link that historical to our model, right? Another way is if you already have like a template, what you can do is, of course, look at our template. We already have a template here we are working with, right? So what we're going to do is, let me see. We can just say income statement. Let's put our heading here, or we come here and Control Shift right arrow key, then press Control 0 to close those ones, to hide those cells or those columns so that we can easily navigate. So let's put one heading here, this heading here. What heading are we putting there? Alt 4. This is our heading 1. We want to put this heading 1 here and call this one. Let me put it on column B. Let's call it our income statement. Income statement. Now you determine how your financial statement or your financial modeling worksheet looks like. Just make it beautiful, make it presentable, simple, right? So next thing is I want to come to this column C and go to this historical. Okay, nothing is in that column C. Escape. Go to column D equals to, I want to link what we have there. Link all this. Link this gross profit. You see? Just like that. Just like that. I want to do a whole of control. Okay, so what I'm going to do is just to, you know, let's assume we want to do everything at the same time, like bring all those values to this sheet, Control D. Right. Can you see what I'm doing? At the same time, we can just, did we bring all the things we want? We can just link to how many years, how many years? Okay, Control R. Now something is going on there, but we are coming back to that. I'm coming back to that. So this is our gross revenue, just like we have over there, right? We don't need this figure. There's nothing here. Is there something there? Can see net revenue. There's nothing here, right? That's why you can see those 0, 0. Are you following me? All
Yeah.
this, all these rows where you see nothing, right? So I can see we copied it up to somewhere. Let's see, where did we stop? Up to somewhere. Okay, bank debt revolver. Well, that's our cash flow. Where's our bank? Sorry, that's our cash, sorry, bank. That's our balance sheet. So we have some more lines to go. Let's see how many more lines or how many more rows. Just this number of rows. So let's go back to our model. Let's do Control D. Now we have everything. Now this might take a little bit of our time, but let's just go ahead and finish it up. So you notice that these figures are not staying on like where they are supposed to stay. So what I'm going to do is just to like move them. Okay, let me remove these ones. So it's because our own order or our own arrangement are not same as theirs, right? So I'm going to like move everything so they can be under the same columns. How many times am I moving? Like how many steps? Let me see. I want it to be 1, 2, 3, all these actual years. So I'm moving them. Did you see that? Did you see that? It's making sense so far, right? So these are our income statements. We have been able to link our historical figures to our model. So these are the actual figures for 2014, 2015, 2016, and 2017 is forecasted year, right? Let's say in our own case now, 2027, 28, 2029, 2030, 2031, just like that. So you know that we have calculated our revenue. So the importance of this is as we are working, we are linking. So this is your forecast here from here. What you're going to do is press equals to and go to your calculation for under the revenue. Remember, this is your revenue figure. This is your net revenue. If it's your gross revenue, so what are we looking for? Gross revenue, right? Remember, we've calculated our gross revenue, the freights and warehouse, and we have our net revenue. So what we are going to do is just come here, go under 2020, 2017 calculation, come here under this, right? So take this is your gross revenue. Remember what follows next under it is the freight, right? So you can just use Control D and, follow it up and use Control R to fill it in. So you can see your revenue grew from 239.2 to 325.5 to 310, So we are going to trace why did this revenue fall over here, right? You can see our revenue fell here, our gross revenue fell here, So we are going to check that one out later. Let's see. Gross revenue also fell here. Net revenue fell here. Let's see, what scenario are we on? Oh, we are even in best case. Let's see, in base case, what happens? Our base case, our revenue figures keep on increasing, and fell on the fifth year. Something must have happened. So we are going to trace that later, right? So the next thing we have computed so far is our operating costs. You can see our operating costs. We have computed our operating costs, right? So let's go to our model, cost of sale, right? The cost of sales is this equals to this. This is our cost of sale 2017. We Control R, right? So the next thing to do is what is our SG&A? Let's go to the assumptions. What is our SG&A? In our assumptions, we said that, look at this, SG&A, growth in SG&A. SG&A grows by inflation. So let's come to our calculation and do our SG&A calculation. Remember, the SG&A is still under operating costs, right? Oh, this one can be called total cost of sales. total costs of sales. So let's do our SG and A. So since it's calculation, let's repeat what we have in our assumptions first of all. Right? Take this, Control Z, right? Control C. Sorry, let's come here. Okay, this is actually on that column. Let me know if you're still following me.
Yes, I have.
All right, so we have our SG&A for the first year. That's for 2017. All right, so let's link it. It's a link, Alt 4. Right, and we said that it grows. This SG&A grows by inflation. Let me see what we have here. So we have our inflation figure there. So let's just link it. Control R, Alt 4, make it a percentage style and a link cell style. Right. So basically our SG&A increases by inflation, grows by inflation times 1 plus the inflation. You can see we brought that inflation close to it, so we can easily link it. Right. So this is our SG&A figure. Right. So we'll go right ahead and link it in our model. Equals to, you can see we are not doing any calculation on the face of our model. You can see if you must do any calculation, it must be something very minimal. You can see it's always linked to your calculation. Can you see? So the total cost is just Alt equals to, you drag it to the right, Control R. Did you understand all this? Let me know if you have any question. Now, this is how you build your cost model. Now, one thing you need to take away from all this thing we've done so far is that our major costs, the major costs of our sales, our variable and fixed costs, you need to model them out, especially the variable cost. You model them per unit. You need to know your sales volume, you need to know the inflation. But for your fixed costs, you model them in aggregate format, right? Because fixed costs relatively remain the same over a few years, right? But your variable costs, they change, they are dependent on the sales volume. So you need to model them, right? So selling sales general and administrative expenses, you know, you can just use inflation rate to grow them, right? And as soon as you are getting your final figures for each of these items, just like your sales, your your operating costs, your SG&A, once you get their final figures, you come and link them to your inflation. Sorry, you link them to your model. We've come to the end of today's class. So replicate all these things, and I believe you understand them.
Yeah.
Whether you see video or not. Replicate and send. Oh,
Please, send video.
Have you
the one I've sent, have you finished watching it?
again?
Mm?
We can start from there, but still send video for this one.
Mm. Okay, I'm waiting for your assignment. Start working on it now.